Also, again, in the credit should have cracked by now vein of storytelling, the New York Fed highlighted in one of their recent posts on their Liberty Street blog that auto loan delinquency has increased. This might not be the most surprising thing in the world if you think about what we've seen from the supply chain and pricing perspective of cars. The car prices increased a lot during the pandemic, and as a result, the loans that were needed for these cars also increased a lot. So loans have increased to apparently they've been increasing about 1% every year, and now we're $18,000 in the first quarter of 2020. So that was the pandemic quarter. And so when people buy a new car, they increasingly need to take out a loan to finance that car.
Yeah.
All of the car or a portion of the car if they've got a down payment or maybe a trade-in. And it's funny because I'm actually one of those people who bought a new car in November 2021.
Yeah, me too.
Have a loan. And so origination, the average amount of newly originated auto loans has increased by 11% through 2020, and another 10% on top of that in 2022. So by, car origination loans had gone from 18,000 in Q1 20 to nearly 24,000 in year-end 2022. This is clearly unsustainable. So should, and then, adding to that, like interest rates have increased, right? So, even as prices and auto loan originations have started to fall post 2022, this amount of financial stress, the unaffordability of these loans, as well as changes in the economy. So overall inflation, potentially some of the pandemic stimulus savings coming off have made these newer loans that were made at the highest levels or highest origination amounts harder to afford. So loans that opened in 2022 and 23 are so far performing worse than older loans. Because in part, the higher prices and higher interest rates. So this is kind of like a perfect storm for for conditions of indicating delinquency. All generations are experiencing delinquency transition rates that are above pre-pandemic levels, or with millennials and boomers above their pre-pandemic levels. And you have a note here that auto credit availability has declined. So credit is tightening. So we're having a little bit of a correction in this space. Car loans are very interesting consumer loans. They've in the recession had better credit performance than homes. People would rather lose their homes than lose their car. But I think, back then cars were also had affordability.
Oh yeah.
And so the cars were more affordable. The loans themselves are more affordable. It was possible to refinance at a lower rate. When rates drops to zero, and we're kind of in that opposite position right now. So it doesn't surprise me that people can't afford their really expensive car loan on their overinflated car price. It just kind of it sucks and it's sad. And it kind of is just backlash to what we've been seeing since 2020.
Yeah, no, I agree. I mean, I think this is a tough one, right? Because there's all these different drivers, to your point, that are converging together to be a perfect storm, right? So one is, as you said, during the pandemic, it was just impossible to get cars, right? And so we had a supply chain issue. I've told this story on other podcasts, but I tried to buy a minivan all the way through 2020, 2021, 2022, 2023. And they were impossible to find because they don't actually make that many minivans anymore. But I paid an embarrassingly large amount over sticker price on a minivan that was lightly used. And I was thrilled to get it, right? So just the constraint from a supply chain perspective and the resulting impact on price, both for new cars and used cars, that was one driver, right?